Forget interest rates. The RBI just dropped a structural masterstroke to save the rupee and trigger a massive FII counterattack. Welcome back to Market Insights with Prakash. Let's decode exactly what happened and what it means for the markets. First, the numbers. The RBI maintained the repo rate unchanged at 5.25%. The Monetary Policy Committee retained its neutral stance, signaling extreme caution in a highly fluid global macro environment. Crucially, the RBI downgraded its FY27 GDP growth projections to 6.60%. Why? They are anticipating an inflation spike driven entirely by volatile global crude oil prices and severe energy supply disruptions. Analytics show 90% of our regular viewers aren't subscribed. Hit that button now to support Market Insights with Prakash. To aggressively counter the recent FII exodus in the equity segment, the RBI has deployed three massive structural realizations. Let's break this down into plain simple language. 1. The sticky money magnet. Previously, foreign investors faced strict limits on lending to the Indian government. Now, the RBI has opened the fully accessible route FAR, allowing them to buy 15, 30, and 40-year government bonds with zero restrictions. Because this capital is locked in for decades, it's considered sticky, meaning it won't suddenly flee the Indian financial system during a global panic. 2. The NRI and OCI fast track. Usually, NRIs and OCIs face heavy bureaucratic paperwork like SEBI registration to buy Indian stocks. RBI is now letting them completely bypass this slow process, making it incredibly fast and easy for the diaspora to pump money directly into the Indian stock market. 3. Subsidized forex hedging. PSUs or banks bring in foreign dollars, they typically have to buy expensive insurance called hedging to protect against currency drops. The RBI has stepped in to heavily subsidize this hedging cost for PSU ECBs and FCNR deposits, making it incredibly cheap to bring large amounts of foreign currency into India. The bottom line, the RBI is aggressively plugging the liquidity hole left by fleeing foreign investors. But the government of India just added the ultimate sweetener. Under the newly promulgated Income-Tax Amendment Ordinance 2026, the government has officially scrapped the taxes that were the biggest friction point for foreign debt investors. 1. The rule. Any interest earned on government securities and any capital gains from the sale or transfer of those securities is now completely tax-free for FIIs and the BIIs. The impact. Prior to this, FIIs paid 12.5% LTCG tax. This zero tax exemption is effective retrospectively from April 1, 2026, subject to standard compliance reporting. The reaction to this announcement was explosive. By making it incredibly cheap and attractive for long-term investors to bring dollars into India, this policy triggered a massive short covering rally in the currency markets. Rupee surged intraday to 95.24 against the US dollar. For such daily data-backed insights, like, share, and subscribe Market Insights by Prakash. Thank you.